The India-US trade talks have hit a wall. Sources tell CNBC TV18 that a deal before the 1st of August is off the table. The US wants a Vietnam-style trade pact, zero tariffs from India, but 20% duties on Indian exports. Washington is also insisting on opening up India's dairy and agriculture sectors, basically non-starters for India. Talks have been halted with no movement expected until August, when a fresh US delegation lands up in Delhi. Now, global markets are also beginning to price in a new normal. The so-called end state of higher, stickier tariffs. Some are veering towards a number closer to 20%. That is an assessment which is higher than even where things were a few weeks ago. These are average tariffs by the time the so-called dust settles and everything is said and done with regards to these tariffs. There are also news reports that sectoral tariffs will be announced around the 1st of August. Separately, US tariff revenues continue to rise. Estimates suggest that US will take in $240 billion in additional new revenue from tariffs this year, and some say, well, this number could actually go higher. In the midst of all of this, global markets, financial markets appear almost unbothered, unconcerned. The S&P 500 and the Nasdaq have been making fresh all-time highs. To talk about all this and put all this into perspective, on the Global Reset today, we have Dr. Raghuram Rajan, the Catherine Dusak Miller Distinguished Service Professor of Finance at University of Chicago Booth School of Business. He's a former RBI Governor, former IMF Chief Economist, and long-time advocate for balanced globalization. Dr. Rajan has consistently warned against short-term wins that come at the cost of long-term stability. Dr. Rajan, great to have you back on this program, sir.
Thanks for having me.
Dr. Rajan, let's just start with the India and US. What do you make of it, sir? What is your assessment? I mean, what happens on the 1st of August now that we know that there isn't going to be a deal?
Well, it's anybody's guess, right? I mean, part of the problem to some extent is, trade deals don't get done in a matter of 90 days, and that to trade deals that the U.S. has to conclude with, the rest of the world, 180, 190 countries. So anything that comes out has to be more of a roadmap, a statement of intent, rather than a detailed trade deal with every I dotted and every T crossed. That was the anticipation, and it was also anticipated it would be a few big countries so that the US could declare victory and say, well, this is working and we're going in the right direction. Now, from what you say, from the news reports, it seems like there are very few deals going to be inked. There are talks going on with the European Union, with Canada, with Mexico, certainly with India. I think the administration needs some indicators that this is working. The worry is that the growing revenues from tariffs and the fact that so far the labor market in the US has not shown any signs of weakness, growth doesn't seem to be falling off a cliff. All this will convince the administration that this is indeed a good strategy. And since the tariffs are only showing up in goods prices gently, I think they are going to believe that the strategy is working. And as a result, we may see more action on August 1st, levying tariffs across the rest of the world. The key question here is, what about the countries that are in the midst of negotiation? And there, I think it's anybody's guess. Is there a number which is set out for India, which is a statement of intent? Or does India get the same treatment as the rest of the world and go up to whatever numbers envisaged for the rest of the world? Right now, it's 10%. But could it go higher? Yes. I mean, the deal with Vietnam is 20%, around 20% for most goods, which then suggests that may be the baseline, or the baseline may be a little higher than that. So lots of worries about August 1st, and the question you raised about why markets are so complacent is a very good one.
And we will talk about that. But, that point that you made, these assessments of how much new revenue the US is taking in, in a way, it does embolden the Trump administration's sort of efforts, right, on tariffs. I mean, this will make them push harder rather than back off.
Right. So, why are they making so much in revenues and playing into the sort of idea that the rest of the world is going to pay these tariffs? Well, I think what's happening, and of course we're all guessing here, but I think from whatever data I see, is that foreign exporters to the United States are taking a little bit of a hit on prices while they're waiting for the uncertainty to clear up. So if you look at Japanese car producers sending to the United States, they have taken a cut in their prices because what they don't want to do is raise prices, given the tariffs that are already been imposed, and then see tariffs cut, and then see that they've lost some market share as a result. So producers elsewhere seem to be taking the hit initially. Some of it is also because the shipments that were in progress when the tariffs were first announced would not be subject to the tariffs. And also, there was a lot of inventory sitting in warehouses that had accumulated before the tariffs kicked in. So, all this implies that producers have some leeway to wait and see before they implement higher prices. And that may give the administration in the US a sense of confidence that, oh, they're taking the hit to their bottom line, which is what we've been saying in the first place. We have to wait and see, but I would guess that more and more of these tariffs would be passed through, and the ultimate tax that is paid on because of the tariffs comes out of the pocket of the US consumer to a large extent rather than from foreign producers. Of course, there's a hidden tax. And given that the administration just came out with a big, beautiful bill, there are tax revenues needed to assure the broader public as well as the investing bond market that the US is good for it. And that requires higher revenues. While the going is good, they will pocket it. What happens if the economy slows sharply? My guess is they look around for scapegoats. That's where the Federal Reserve comes in.
Mm-hmm. Absolutely. And of course, there's also, in terms of why the strength, and you alluded to the strength in the US economy, et cetera. I mean, maybe, the inventory was built up, there was some front-loaded spending, et cetera. So that means some resilience, but maybe pressures will show up in the second half, as many are expecting. Dr. Rajan, just to go back to India, US for a quick bit, and then we'll sort of go into the global stuff more. What, according to your mind, would be the thorny, sticky points here?
Yeah, so my sense is there are some very visible industries where Indian tariffs are quite high. So cars, for example, and those are places where our industry has, over time, developed its own models, its own strength, and I think it's high time we opened up in those industries where we certainly have no infant industry argument left. And also more broadly, I think the strategy, both of the earlier NDA government as well as the UPA government, of steadily bringing down tariffs was a good one because it exposed our producers to competition and it forced them to up their game. Since that time, there has been a certain movement back to higher tariffs, sometimes with the intent of enhancing our own industry. But any such tariffs have to be very, very targeted and very temporary. And unfortunately, that usually doesn't turn out to be the case. So I would say, we can certainly give in some areas where it may be to our benefit. And in that case, we should make the tariffs low for every country, not just the United States. There are certainly non-tariff barriers where we have, erected regulatory impediments to foreign direct investment from other countries. Think of Amazon, Walmart, in order to favor Indian domestic champions. That we should re-examine. If we want foreign direct investment, we have to give them a level playing field. We can't say as soon as you become a competitive threat, we will constrain you. That's not good for our consumer. It's not good for our national reputation. So how do we ensure that these non-tariff barriers don't go up? That's something also to keep in mind. Again, it would benefit us. The sticky points come with agriculture, which is politically a very sensitive sector in the US, but equally, if not more sensitive in India, where the margins small farmers have are very, very thin. and any kind of disruption to their production, whether it be in dairy products or whether it be in agricultural products, could be quite devastating to their livelihoods, and we don't have a strong safety net. So in these cases, I would tread more carefully. But if we can negotiate some kind of process by which our farmers, our agricultural producers are also benefited, that would be a potential win-win. So rather than declaring this whole sector untouchable, let us see what they could benefit from. Maybe foreign direct investment in agri-industry, maybe something we can facilitate, ease, and even support strongly so that our farmers benefit. Maybe there are some third countries we could do joint ventures with, and so on. I think here the issue is what ideas can we come up with that ensure that we don't really subject these sectors to unfair competition.
Absolutely. Point taken. Dr. Rajan, on that, just this is the overall tariff rate. Do you think overall assessment, and I feel that when I speak with lots of people, that people are repricing what this will finally end up at? I mean, it was between 10 and 15% till a month ago, maybe even a couple of weeks ago. But now more and more people are sort of coming around to the 20%. I heard a 25% number. Of course, I mean, with fingers crossed that maybe we don't get there. But do you think those are numbers which the global economy is prepared for?
I think the quick answer is no. I don't think it's prepared for those kinds of numbers. I think there was the expectation this is all sort of sound and fury, signifying nothing. That at the end of it, we will get maybe a 10% across the board, and maybe a couple of sectors it'll be higher. But what it seems to be drifting towards is something higher because the consequences haven't been felt in the US right now. And you must remember that economists are broadly discredited in this administration. Oh, you guys have been warning about the end of the world for so long. You're part of the elite. You're sort of pushing free trade, which has hurt America. The protectionist streak in the administration, certainly in President Trump, who has been advocating protectionism since the 1980s, and some of his close advisors, Peter Navarro and formerly Robert Lighthizer, is that this is going to benefit the US. So my sense is that we will have to go through a period of high tariffs and see the consequences of that before we decide that maybe the world is better off with lower tariffs. And unfortunately, the problem is once you go through a period of high tariffs, the advocates for those high tariffs become strong, and it sort of sets in place. It's hard to remove without a serious downturn to the economy. That's what we experienced in India. We had to have a crisis in the early 1990s to get rid of our, license permit Raj. And I think the US is drifting towards that and will stay there until things get really worse. So one is the across-the-board tariffs, which may be higher than 10% in the days to come. And the second is the sectoral tariffs, which are even more insidious because they could be much higher, and they will be in key sectors that affect India, for example, pharmaceuticals. And this is something to worry about also going forward. Any of these agreements that countries conclude, what does that imply for the sectoral tariffs that emerge?
Dr. Rajan, hold that thought. We're going to come back, continue this very interesting conversation with Dr. Raghuram Rajan. Welcome back. We're in conversation with Dr. Raghuram Rajan on tariffs, trade, economy, and of course, financial markets as well. Vietnam's 40% rate on transshipments, Dr. Rajan, is clearly aimed at sort of preventing China from avoiding tariffs, right, by exporting via third countries. Now, if 40% is the rate on transshipments, surely the rate for China will not go below that level? I mean, we don't know yet. We got that sort of a handshake deal that one Sunday morning, but we've not heard anything since. So we don't know where those talks are as well. What's your sense?
Yeah, no, No, I think the administration's policies with respect to China are very, very unclear.
Mm.
On the one hand, on the defense side, you hear again and again, China is an imminent threat. We need to do more. We need to get Korea and Japan to agree to declare war along with us, et cetera, et cetera. That's the kind of talk that's going on the defense side. Ukraine, a shift away from Ukraine and Russia to China and Taiwan. But if you look on the trade side, certainly the early days of 140% tariffs on China, very quickly, a lot of business people got to the administration and said, this is a disaster because we depend on China in so many ways, and this will kill US industry very quickly. There are a lot of choke points where China accounts for north of 70-80% of our imports, and if we kill those imports, we can't ship quickly. So that's where the deal with China came. The U.S. discovered that as a big buyer, it was not just had market power over the seller, but it was also vulnerable to the sellers deciding not to supply. Rare earths is a clear example where they have the foot on the US's jugular. So that caused the US to back off. But 34% is below the 40% transshipment rate. Of course, there are other additional tariffs, and sometimes it's very confusing what adds up and what doesn't. Do the fentanyl tariffs that are imposed on China add up to the additional tariffs that have been proposed or not? But the bottom line is that the US understands that it doesn't have unilateral power vis-a-vis China. And China has been quite clear that it's willing to take the pain if the US wants to go the unilateral way. So that negotiation is going to be very important. Will it result in Chinese tariffs being above 40%? Unclear. But my sense is that if you're going to tax transshipments at 40, logic would suggest it would be somewhat higher, or it would be around that level. But let's wait and see. I mean, there's a lot that's unclear as you've noted about these tariffs.
Mm. And from a purely sort of a financial market perspective, there are lots of things kind of driving that, right? I mean, on AI, NVIDIA is such a large constituent of the indices, allowing NVIDIA to export chips back into back to China. I mean, that was a big push. NVIDIA, $4 trillion in market cap. I mean, there's R&D accounting sort of relaxation. That is, again, I mean, I think the large US tech firms are some of the biggest spenders of R&D, so that helps them as well. So when we look at equity indices in the US and say, well, all is well, maybe there are these, idiosyncratic factors driving and keeping these indices at all-time high, and may not be
Yeah.
completely reflective of the underlying economic situation. Would you agree, Dr. Rajan?
Yeah, I mean, look, I'm from the University of Chicago, where markets are supposed to be generally good reflectors. So we have to ask, what is it not capturing?
Yeah.
But typically, I think markets don't capture big changes in policies. At least traders don't seem to want to, incorporate that. Remember, Brexit was not captured very well in market indicators before it happened. I think trade tariffs are another sort of big mega changer that we don't quite know where they will land. And for now, the market is willing to take a more benign view of them under the sense that the administration generally is using them as negotiating tactics rather than as some kind of a longer term target. But I think a couple of other factors are in play. One is the sense that the Federal Reserve will cut interest rates further over time, and that will hold up markets. And the second is that somehow there is a lot of productivity coming down the line, in part fueled by greater investment, AI, power, all those areas that you just mentioned, but also the implementation of AI in industry, which has yet to take off, and that could imply gains in the United States with the innovation. So that's something else that's probably on people's market investors' mind. I think finally there's a sense of either the Fed or the government put, which is if things turn south very quickly and the market tanks, that the government and the Fed will come to the rescue. I think that sort of belief has been verified many times in the past, but at some point it may be really difficult for that to play out given the increasingly strained government finances. But we'll see.
Before the Fed put, now there is a Scott Besson put, apparently. I'm not sure. But
there are various puts. There's a Trump put also that, President Trump sort of backs off on more. Remember what happened after Liberation Day tariffs were announced.
Yeah.
So lots of belief that things will sort of revert to some kind of a old normal.
Yeah.
But I'm not sure that that kind of belief is justified. We have to wait and see.
Yeah. Another phrase I'm increasingly starting to hear is fiscal dominance, Dr. Rajan. You think it'll, the executive forcing or putting pressure, at least publicly, in a very public way, on the Federal Reserve to cut rates is one way of fiscal dominance. If it comes to, Fed may cut rates not because of the pressure, but maybe because it wants to down the line. But what is your sense here?
Well, first, just for your viewers, fiscal dominance reflects the subjugation of monetary policies, either voluntarily or involuntarily, to the needs of the government's big deficits, the need to finance it. One example of this is when the Fed becomes overly concentrated on keeping long rates down because the government has to refinance some of its debt and issue longer term debt. And that sort of is an important factor. In India, we had this pact between the RBI and the government that the RBI would not simply do open market operations to finance the government. That was when the RBI got liberated from fiscal dominance to some extent at that point. So what we're seeing today is a lot of worries expressed in the U.S. Given the U.S. fiscal deficit is 6.5% of GDP, and it's probably going to grow some with the big beautiful bill that has just been passed. That kind of deficit means the government debt keeps growing, and the need to finance that government debt becomes more important. Given that many countries, investors are relooking at their portfolios and wondering whether they're overexposed to the US and pulling back in some cases, financing the US government's deficit becomes more difficult than in the past. So, one of the pressures on the Fed from the government is bring interest rates down because it'll help us financing. You're not being completely good citizens if you don't do that. The problem, of course, is the U.S. Fed has control over the short-term interest rates, but no real direct control over long-term interest rates. If it cuts short-term interest rates and everybody thinks this is being done to satisfy the government, then it is quite possible that there are fears of higher inflation in the future, and long-term interest rates start going up rather than going down. That's why everybody who has looked at this has been warning the government, don't push the Fed too hard. You may have the opposite effect to the one that you intend, which is lower, longer interest rates, long-term interest rates.
Dr. Rajan, I have to ask you this. Do you think Chair Powell's job is safe?
I think it is, in part because I think that, getting rid of him will not change matters. In fact, makes it harder for the incoming chair because they have to show they're not completely under the thumb of the government for reasons I just said. An independent central bank has more influence over interest rates than a poodle of the government. But also, I think, all the sound and fury also sets up a scapegoat. Who's going to be blamed if the economy turns down, which, there are signs of slowing and it may well slow in the second half? Well, you'll blame the Fed. And, that's always good for a government to have somebody to blame.
Like a nice foil, basically. I mean, keep berating, keep attacking, but I mean, don't do anything about it, right? No point taken. You know, the last time we spoke, Dr. Rajan, I asked you what is the one sort of non-consensus thing. I think is how I put it. And a lot of people, when I told them I'm interviewing you again, have asked me to ask you. Uh, it's not been that long since we last spoke, but anything which you think, which you're thinking about, which you think others are not thinking about, which is sort of, really off tangent in that sense?
Well, look, I think I'm thinking about all the things that everybody else is thinking. So I don't want
Are
to.
you thinking
I
about
mean,
something very differently that what the
well,
consensus out there
look,
is?
well, on one thing I do think about is AI and coming down the line.
Mm.
We're certainly seeing that AI has made programming much easier, and you can generate many lines of code by just asking for help from programs like Cursor and so on. I think that that sort of gives us an impression AI is going to be, surrounding us very quickly in every area. My sense is that it is going to take much longer in some areas than in others for AI to make a mark. And the reason I say this is many companies don't really have their data properly sifted out in order to use AI better. And in order to do that, they have to start working on data management, data analysis, for which they need to employ a whole bunch of consultants. Consulting is in deep doldrums right now. And so all that gives me a sense that maybe this point that many people are making, AI will kill a lot of jobs in the next couple of years, is probably overstated. That it's going to take longer for AI to roll out. Some industries faster, that is areas like software programming, but in some areas it was going to take much longer. And so what we talked about, the sort of market valuations based on a huge rollout of AI. Maybe it's more in the investment, maybe it's more beneficial to NVIDIA, but it'll take time for it to show up in productivity numbers for industry.
That was very interesting. It was food for thought. And hopefully we can speak more about this in our next conversation. Dr. Rajan, we went over a whole bunch of issues today. Thank you very much for taking out the time. Really insightful for me and, of course, for our viewers as well. Thank you very much for joining us on this episode of The Global Reset.
Thanks for having me.